What's up, investors? On this episode of the Note MBA podcast, it's the spring break edition. It doesn't sound as exciting as it isn't as exciting as it sounds. Anyway, we keep our shirts on. It's just me this week. I'm answering some listener Q&A. We're talking about the difference between having a good life and a hard life. We talk a little bit about goals, why I'm not drinking this year, and a few other things. It's a short show this week, but it's still worth your time and effort. Have a listen right now.
Hard decisions, easy life, easy decisions, hard life. And I don't think often enough times I am making choices and decisions with that framework in the back.
First, seconds, performing, non-performing? What the f***? Note buyers, when it seems like you're in this business alone, know Chase, Robert, and the rest of their tribe are at it every week. They're bringing updates from their own note businesses as they work to find, fund, and finish deals. Follow along as they share their grassroots education with you, tuition free. If you'd like to know more about what they do and to download the entire back catalog, check out notemba.com. Now, here are your hosts, Chase Thompson and Robert Woods.
Hey everybody, welcome to the Note MBA podcast, your home for note investing on iTunes. I am Chase Thompson, and it's spring break week here at Note MBA HQ, so we'll catch you guys next week. So I toyed with how long to make that moment of silence, a lot like when you call somebody and they're like, hey, and you're like, hey, what's up? Hey, da-da-da. And they're like, hey, I can't hear you. Da-da-da. And they're like, psych, you got voicemail. So I wanted to create a similar experience here, but I didn't want you to leave. So I figured I shouldn't go too far with that moment of silence. Hopefully it worked for a couple of you, and it was like a quick little, he got us. Anyway, it really is spring break week here at Note MBA HQ. So today's show will be much shorter, just a couple of things to tackle with you guys, and we will be back to your regularly scheduled Note MBA sweet real estate content next week. Today, though, with just a couple of minutes with you guys, I wanted to address just a few things. The first thing I wanted to address with you guys was a couple of questions that we got sent to us via email. You can always send questions to us over at ask@notemba.com. And these were specific questions, to be sure. However, they've come numerous times in different-ish versions and incantations and things like that. So I thought, instead of attributing it to a single person, and we get these two questions so often, that I would just address them here, and then you can have fun with the answers if you're someone who's asked these questions, or potentially if you're someone who would like to just know the answers to these questions. So here we go. Here's two of the most frequent questions we get. Question number one is, what are the main metrics or numbers or things that you guys are looking at when you're investing in real estate properties? So this is incredibly broad. Most of the time we're not answering it. Sorry if you've sent us this email, but it's such a broad question, and it really begs the question, have you done much research at all yet? But I did want to address it here, as we're going to have a shorter show, kind of an off week. So I guess I'll give you a couple of the things that I look for, that we look for, that you should potentially be looking for when it comes to doing deals. We've addressed this a couple of different ways over the past few episodes, but the first metric, the first thing that I think that is really important for you to look at is cash flow, from the perspective, if S hits the F and things really start going sideways, can you afford to keep the property? Can you afford to have it, float on, say, rental income, or whatever the case may be? If you're not able to move the property, or say get that loan modification you're looking for, or something like that, always look at whatever your worst case scenario exit strategy is going to be, and figure out if that potential deal is still viable to a certain extent. When it comes to notes, we have a ton of different exit strategies comparably to, say, other types of real estate investing a lot of times. So oftentimes when we're running ROIs, and you should be doing the same, we're looking at what happens if this deal modifies. What happens if this deal becomes a deed in lieu? What happens if we have to go to foreclosure? What happens if we have to take it back in a scenario? What happens if it becomes a rental? What happens? So we're looking at multiple different exit strategies. And oftentimes you're going to come out with, say, 3 out of X that look really great, or 2 out of X look really great. Rarely should you be pulling the trigger, I would say, if only one strategy looks profitable. That is to say that if every other strategy doesn't look great, but more specifically looks terrible, and only one looks really great, it might not be the best way to go about it, especially when it comes to firsts. Now, seconds, a lot of people are doing that obviously for cash flow play. So that's the exit, right, that you're going for in some way, shape, or form. When it comes to something like firsts, that's something that you might want to look at as a possible metric for pulling the trigger or not pulling the trigger, right? The next up is pretty easy for anybody who's been doing this for any given time at all, and that would be location, location, location. It's the classic answer when it comes to real estate. Oftentimes, it's looking at, do you want to be the best house on the worst street or the worst house on the best street? Or do you want to invest in this market over that market or this state over this state? And for us, that's even more important because, again, with traditional real estate, oftentimes you're investing in your own backyard so frequently that you don't really have a choice. You're looking at maybe a different side of town or a different side of the tracks or something like that. And in the case of notes, you can specifically say, no, I'm going to avoid whole states. I'm going to avoid whole pockets of the country. I'm going to only look at these 2 markets, period, or whatever the case may be. So it becomes even more interesting from that location aspect when it comes to note investing. But that's going to be another metric to look at. And then, of course, something that, again, just seems really obvious, but can you actually do the deal? If a property, and this is something, again, we've touched base on oftentimes on this show, but if this particular asset, you can pick it up for, say, $20,000 in JV capital, but it's likely you're going to need some holding costs or cover a foreclosure cost or whatever the case may be. So really all in acquisition might be something like $25,000 and you only got $20,000 in JV capital. Do you have the other 5? And if not, that's not a good deal to do. And that seems obvious, but a lot of times it isn't, especially for new investors or somebody who's an experienced investor that's just trying to maybe do a deal in an area that they love to do a deal in. They're running the numbers. Things look a little bit tight, but I could probably, sometimes that isn't necessarily the deal you should do. Other times it's a great deal to do. Just look at some of these different factors, right? And some of these different things that we're looking at. So of course, some small caveat things to look at, which kind of come down to the location. Can I afford it? And of course, the cash flow situation. Some other things to look at, of course, are taxes in the area, what foreclosure, scenarios look like in the area, what it looks like your holding costs might be because of the foreclosure and or tax scenario that are happening, timing, price, all of these things are really important. But when it comes down to the metrics that I think a lot of people don't necessarily look at, or especially for those that haven't done research, what's going to happen worst case scenario, that cash flow situation, the location situation. Is it a deal you can actually do? Do you have the money to cover those additional costs? And then the last kind of hidden one that I don't see a lot of people talk about, and we talk about it a lot on the show in various different ways and using various different terminology, but I rarely ever see anyone ever talk about it when it comes to these home flipping shows and other things like that, is carrying costs. Almost no one ever talks about carrying costs, especially in the flipping space. It's like they all know it's there, but they just don't talk about it in the same way as I think they should. So for us, those carrying costs can be exacerbated, right? Because if you're looking to do a flip that's going to say take 3 months to do the flip, and then of course now it's ready to sell. So a lot of people go, all right, I got 3 months of closing or carrying costs. Well, you don't really, because unless that particular deal sells immediately, which sure, I hope it does, but what if it takes a month and a half, 2 months, whatever the case may be, you're going to have these carrying costs. And I'm not just talking about the carrying costs of what your money costs. What about taxes or utility or other varying costs that might come up? You have these, lawn care. I mean, just random different kind of costs that will come up for a property that's just sitting, right? And for us, it's the same thing. We talk about maybe REO as an exit strategy after, say, a 9-month foreclosure time, right? So you go, all right, I got 9 months of foreclosure, carrying costs. Maybe. What if you got to do a month of reno, just a little bit of paint and carpet, right? And then it takes another month to sell. And then it takes, really take a second and take a step back and look at kind of that hidden, not a lot of people talk about it, carrying cost number that can become very important very quickly on a deal, as that might eat into what is your expected return super quick if it's not something that you've already looked at. So those would kind of be some of those metrics that we look at, I look at when it comes to doing a deal or not doing a deal. And we've talked about them numerous times on the show, but those would be some things to take a look at. The next question that we get sent to us most frequently, and it's regarding the shows that we've put out there, and of course the content I put out there and the things that we talk about regarding marketing. So a lot of people want to know where they should be marketing. What networks or which application should they be, all of that type of stuff. So for me, really quickly, I'm just going to run down what I feel are the 3 kind of top social networks, top places that you should be marketing on the web for your business, and kind of give a little bit of insight, not dive too deep, but I just want to be able to kind of address this really quickly on the show. So number 1, the absolute most important place for everyone who is listening or who is within the sound of my voice, you have to be on Facebook. And I do not say that flippantly. Yes, there is bound to be investors out there that are just crushing it without being there. No doubt about it. I'm sure they're out there. Next time we're at an event, please come introduce yourself to me. I would love to talk to you and the strategies you're using. But regardless of if you're not there, if you were, I'm telling you it would be easier. And if you are there, kudos, because now you can finally start marketing appropriately. I mean, Facebook is the homepage of the internet for hundreds of millions of people. It's one of the few sites they visit regularly, not only on a daily basis, but even a monthly basis. It's email and Facebook for a lot of people. A lot of people. They've got something like 1.6 billion users. Listen, it is a huge piece of the market. You need to be there. It is an absolute beast when it comes to marketing for you, and you need to be there. You can talk about your business in an open way without being pushy. I just closed on this deal, or I'm really looking and really excited about entering a new market here, and just drum up that excitement without being pushy, which is fantastic. But you can also do the traditional marketing stuff. You can do ads. You can have a business page. You can do all of that stuff as well. You can target just so unbelievably, so narrow, laser focused. You could do scattershot if you want to. I mean, there's so many different strategies and things that you can do. That is a place where you have to be. The 2 follow-ups to that would be YouTube, which a lot of people forget is and can be a social network. Video marketing is so important. It is something that is so easy and ubiquitous to do. You have one of the best cameras you've ever owned in your entire life right now in your pocket or your purse or on the table next to you or in the console of your car if you're listening to this in your car. Your cell phone has one of the best cameras you've ever owned in your entire life on it. It is so easy to do video marketing now. Get it pushed out there to a place like Facebook, obviously, but also YouTube. It's a killer place to be marketing right now, guys. And then lastly, I personally feel like it's kind of a toss-up between your personal style, but it's going to be Instagram or Snapchat. Snapchat if you're a little younger or you're looking to, say, reach that younger demo. Instagram is just obviously much more established. They're owned by Facebook. They have a lot going for them. But one of those 2 is going to be the toss-up, which is just generally going to be dependent upon what your style is, I think. And if you want me to dive a little bit deeper on that in future episodes, we definitely can. But that would be my answer regarding where you should be at. The other obvious one, which isn't a true social networking, is email. You should obviously have a database of sorts. You should be sending out emails regularly about what's happening in and around your business. I've talked about this copious times on the show before, but those would be those top tier places, and in that order, by the way, that I would be focusing on my marketing. If you are, say, new to marketing, or you just don't want to attack it with as much aggression or vigor as you should, probably, stick to just one. And if you're going to stick to just one, I'd say make it Facebook. And then after you've managed, right, to do all that you can do and be super effective on Facebook, any next level stuff would become too pushy or too whatever, in your opinion. Then continue what you're doing there, spin that plate, as it were, after I just wrote an email about spinning plates in your business and doing projects. Then I would move on to, say, a YouTube or an Instagram or something like that. Get yourself established on one, rock and roll for a while there, keep keep chugging and chugging and chugging, and then add another one and chug and chug and chug. And then see if you can run those two simultaneously. And if you're really knocking that out of the park and you're really seeing the gains and the growth that you want to see with your business, then potentially add an augmented one. That's how you should really be attacking this. So those are two of kind of the biggest listener questions that we get. And that's kind of my general thoughts on those two different concepts and different ideas. The next thing I want to address, technically the next two things I want to address are going to be some listener feedback kind of requests. We're coming up to the end of March. I want to know where everyone's at with their goals. We talk about goals. We talk about these habits and tactics and things like that we're implementing in and around our lives and businesses and all that kind of stuff. So I just wanted to touch base with anybody willing to send us an email, ask@notmba.com. You can send it to me personally, chase@notmba.com. Personally, I'm doing pretty good. I could be doing so much better. Recently, I read an article that I'll link up in the show notes over at notmba.com about some research that was being done by a research team that they, again, for anybody who's been a human for any period of time knows that what they basically found out and discovered is that we have a tendency to track towards the least resistance path, the path of least resistance, as it were. We just, it's like water flowing downhill. It's like electricity. It's light. It's anything else. It's Google Maps, right? It's all just going to track to the path of least resistance. We as human beings are the exact same way. And, to cite a little bit of the article or the research, the top researcher on this particular piece, he actually says our brains trick us into believing that the low-hanging fruit is really the ripest fruit, which I think is so great. We often talk about that. Oh, this is the low-hanging fruit in my business. This is the low-hanging fruit for me on a personal growth scale. And so we trick ourselves into thinking that low-hanging fruit, right, that's the ripest, that's the best, that's what's worth it. We're in an orchard of fruit, just trees and trees and trees. And man, that apple at the top sure looks great, but that apple right in front of my face sure looks better. That's what we always look at. Recently, I heard somebody say, hard decisions, easy life, easy decisions, hard life. And I don't think often enough times I am making choices and decisions with that framework in the back of my mind. And this research obviously would play out to essentially say the same thing. We'll do everything from rationalize and denial and distract and all of these different things just to not make those hard choices. One of the things I've been doing all year, which is really shocking to me every time I think about it, but for no other reason than it just takes a few less calories out of my, or a few calories out of my diet as I'm trying to work on that, is I haven't had any alcohol all year, which is really easy for some people, really hard for other people. For me, it's just kind of been a thing that I've decided to do. But that was kind of a hard choice, right? Like my wife and I love to go sit on the patio in South Texas and get a margarita, or it seems like such an easy decision to just say, no, but it really can be difficult. And this seemingly easy, but got to be honest with you, kind of hard decision is making life a little easier. I don't have to worry about it. What do I want for drink? Just water. We're good, right? Like sometimes an unsweet tea is good too, but it's really making my life easier. It's helping me to not make bad choices when it comes to what I'm eating. And it's helping take some of those calories off my plate. It's doing a lot of that for me. That hard choice is making life easier. But it's a choice I have to continue to keep making, at least for now, until it becomes second nature. But hard choices, easy life, easy choices, hard life. And I find myself there sometimes. So I just want to know where you guys are at with your goals. I want to know what your thoughts are in this general process when it comes to business. Are you making and doing the hardest things first when you get into the office? Or are you just milling about a little bit on Facebook and not attacking the things you should be attacking? And then it gets to the end of the day and you're scrambling. How is it that you're attacking this? I would love some help and just to get some perspective from you guys. And then the last thing I would like listener feedback on before we close out today's episode is a bit of a conundrum. I don't know if conundrum's the right word, but I hear these two things often said from the same mouth, right? From the same person without any sort of check for the fact that they are completely... Here's the things I hear people say. I hear people say that they're not sure what price band they should be investing in. They don't necessarily want to invest in the low value $15,000, $25,000 properties because XYZ reason, but they don't want to bump up to the $150,000, $125,000, $200,000 price or up price bracket, because then they're starting to invest where people have money to be able to hire attorneys and kind of fight it. While at the same time, though, people will say they don't love necessarily, but they do appreciate when a deal gets to the point of, say, foreclosure, or there's some sort of mitigation kind of factor comes into play, because now they're dealing with a professional on the other side. They're dealing with an attorney. It's attorney to attorney. They're dealing with professionals. So how is it that they can like to deal with professionals on the other side of deals, but then at the same time not want to jump up in price band when it comes to investing because they don't want to be working against people who can afford professional representation? Kind of a strange thing. Now, I definitely get this idea that, then they'll have then they'll know when they can file BKs and they can, yada, yada, yada. I get all of that. And we can definitely have that conversation. And that's why I want listener feedback on this one. But I find it to be hilarious and kind of bizarre that all at once people love dealing with professionals because they don't love all of the minutia and that can come with just dealing with the emotions of the homeowner. They want a non-biased professional on the other side, except in a price bracket of, say, 125 and up or 150 and up or whatever the number is. I find that to be a little bit odd. It's interesting to me that this would be said from the same person. And I've heard it if I've heard it once, I've heard it 1,000 times. So I find that to be interesting. And I guess I'll leave it there. I would love y'all's feedback on that personal growth goals kind of idea. Also on this issue of where are you investing price band wise? What are your thoughts on having professionals on the other side of it? Do you avoid certain price bands because they can probably afford an attorney? What are your thoughts on this? I'd love to know. On top of that, and the last thing that we'll say on this week's show is my wife demanded that even if this was the spring break episode, that I had to do a show because she wanted to thank each and every listener who took part in Robby's idea of having an Amazon link, kind of link up thing for the birth of Milo, my third child. So many of you just poured out on my family amazing blessings by going over to Amazon and picking up a little toy for my son, or some bibs or diapers, or just these other random things. She wanted to thank you again because he is now officially 6 months old, and we just this weekend have to go buy our first box of diapers. And it was all thanks to the listeners of this show. I'm still in awe and completely floored and amazed at how great and wonderful and just fantastic you are as a community. And she just demanded that I do a show to thank you one more time for that outpouring. I appreciate every single person who partook in that. Some of y'all didn't even put your names on things, so I can only assume, that it was from different people. So thank you again so much for everyone who participated in that, and just anyone who's listening in general. And I think that's where we'll wrap up for the day. If this is your first time here, be sure to head over to iTunes, give us a rating, give us a review, and of course subscribe. It helps us out tremendously. If you want links to the research article I talked about in the show, you can obviously head over to NoteMBA as always to check out any links that we talk about in the show over at notemba.com, which, by the way, is now live. We have a homepage and a podcast page, and there will be much more resources there soon. I'm very excited about it. And as always, be sure to tell 5 other people you know this week about the NoteMBA podcast. We'll catch you guys next week, fresh off a sweet, sweet, rejuvenating week from spring break. Bye, guys.